what the Treasury market has done with the rise in yields is no longer does the Federal Reserve, Scott, have the luxury of waiting to see if the rate hikes, the tightening of the balance sheet, will bring down inflation. The market is telling them they can't wait any longer, and I think that is crystal clear right now, and that's why I think you will get a pause.
Well, it just happened. The Fed is getting ready to pivot and cut interest rates sooner than you think, and that's going to have a massive impact on asset prices, the economy, and inflation. And what I find super interesting here is that in every economic cycle, the Fed does pivot. And it's not a question of if they're going to pivot and cut rates, it's a question of when they're going to pivot and cut rates. And right now, Jerome Powell and the Federal Reserve are very hawkish. And we are getting information that the Fed might actually decide to reverse course in December, because as things in the financial system have just decided to break, and after the craziness we saw in the UK's financial system in the past couple of weeks, this has now come across the board to the US and is not really being talked about as much. So what exactly are the things happening right now in the financial system that are causing things to break? So let's talk about what just happened, the new changes that are about to take place, which of your investments are most likely to be affected, and then how you could use this information to make you money, especially when the Fed is about to completely flip the market. But before that, it would mean a lot to me if you gently hit that like button and subscribe for the YouTube algorithm. If you haven't done so already, it's totally free and it takes just a split second. Now, before we cover the Fed pivot, I need to cover exactly what has been happening this year. And I already said this before, but in 2020, we had the lockdowns, we had unemployment skyrocketing, we had GDP fall by 3.5% and the stock market going up by 16% as a result of so much money being printed by the trillions of dollars. And all of that inflated everything, including the stock markets. And by the time Jerome Powell realized that inflation was transitory, it was too late for the damage to be undone. And right now, he's trying to clean up the mess that he and the Federal Reserve have created. You see, the Federal Reserve stopped the money printing and they've been raising interest rates since June of 2022. But then the Federal Reserve took it a step further and started removing money out of our system. And this is called quantitative tightening. Now, this process of quantitative tightening, it's already started. Now, this is already causing a debt crisis, and it's also causing a liquidity crisis, and it's going to cause a lot of damage in the bond markets, and you guys have already seen the effects on the stock markets. As you see, when the Fed prints money, the stock market goes up, and when the Fed takes money out, the stock market goes down, and that's why you don't fight the Fed. The same thing is happening to the cryptocurrency markets, and the real estate markets as well. Which also brings me to the massive warning towards the Fed's current policy from the United Nations, saying that the Federal Reserve and other major central banks are at a risk of triggering a painful global recession if the Fed continues to aggressively increase interest rates. And this has also led to a surging dollar, so everyone is calling for the central bank to pause or reduce interest rates, or just completely pivot. So now that you understand what has been happening this year, then you now understand that interest rates are hurting the economy. You can look at America's GDP. The economy grew at a rate of 5.7% in 2021. Compare that to this year when the Fed started raising interest rates, the first quarter of 2022, which was negative. The second half of this year has also been negative.
Now, I wanted to add something else here because the negative GDP numbers that I just went over means that we're actually in a technical recession. Even though there are many people saying that we are not in a recession, even the White House went out to say that we are not in a recession. But GDP numbers in Q2 went down, and this was followed by a decline in GDP numbers also in Q1. And that's 2 straight quarters in a row, which means that by definition, we are in a technical recession.
And look at the stock markets. Here's the performance year to date. The S&P is down 22%, the Dow Jones 16%, the Nasdaq down 32%. I mean, look at the housing markets. We have 30-year fixed mortgage rates above 7%. Existing home sales are down 20% from a year ago. And let's talk about employments. Now, here are the jobs added in the monthly employment reports from January of this year to August. And you do notice a trend. I mean, I do. It's going down, and I want to explain the situation to you. So inflation is still way too high. You already know that. So raising interest rates, it hurts the economy. I mean, I just showed you what's going on with the GDP, the stock market, the housing market, and the labor market. And as rates continue to rise, we see more slowdown in the housing activity. Mortgage applications are down 2% on a week-over-week basis. And on an annual basis, purchasing power is down 39%, while refinancing is down 86%. And now here's where things are actually starting to break. And pay attention to this. Because of the high inflation, central banks around the globe have been tightening their monetary policy, and most of them have raised interest rates and have started to shrink their balance sheets, meaning that they dump treasury bills on the market. And this tighter policy should lead to a weaker economy, and weaker economy should slow down demand. And decreased demand on its turn should lead to a decline in prices, resulting in a decline in inflation. Therefore, it's noting that the Bank of England decided to make a 180 and pivot from quantitative tightening to easing to avoid the free fall in prices of UK treasury bills. So then they decided to stop dumping treasury bills and start buying them. And it shows how quickly the war on inflation becomes a secondary priority when the stability of the financial sector is at a high risk. And as a result of the Bank of England and their pivot, we could potentially start to see the same thing happening for the US very soon. Because something that is breaking the markets is that many insurers, pension funds, and commercial banks are actually holding large amounts of US treasuries on their balance sheets. And to avoid that, eventually the Fed would need to pivot and step in as a buyer of a last resort. So more than likely, the Fed is going to pause in December. And in my opinion, that is going to be good news for the markets. I believe that they will be forced to pause and then pivot in the beginning of 2023, which is going to be a signal the recession and the job losses in the labor markets are going to get worse. Therefore, the Federal Reserve will pivot because the federal government needs it. And when that happens, we're going to get more inflation and everything will inflate, including the stock markets. And just to be clear, this is not a good solution. This will actually just make things worse. And so what the Fed wants to pay attention to is core inflation. I mean, that's the metric that they want to use. Well, CPI core inflation has been increasing in recent months. July CPI core inflation was at 5.9%, and August was at 6.3%. September, it's 6.6%, and core inflation reached its all-time high since 1982, its highest level in 40 years. So we're going to go off this metric, and in terms of what's going to happen in November, the Fed will have no choice but to raise interest rates hard at the next meeting on November 2nd, therefore resulting in a higher unemployment rate and bringing inflation down, resulting in a Fed pause in December. So to conclude, the Federal Reserve wants to increase interest rates as long as they need to tame this inflation that we're experiencing right now. But this has also come with the economy going on a downfall. And as long as inflation rate is at around 8% year over year and we have a higher labor market, then the Fed is going to continue increasing interest rates in the shorter term. But we could see a pivot in the Fed policy towards cutting rates and when the unemployment rate goes up to 5%. So basically, the Fed is going to pivot, and I think that's going to happen sometime in early 2023, more than likely Q1 of 2023. So eventually, the Fed pivots, say in early 2023, to cut interest rates. Now, that's not going to save the economy. That's going to be a signal that the economy, the Main Street economy, is going to get a lot worse over the next couple of months or years. And that's when asset prices are going to go down, because if people lose their jobs, they don't have as much money to spend. Consumer spending goes down, businesses have to lay off even more people, and businesses have to shut down, their earnings go down, and thus their stock prices go down as well. By then, the US will have declared that we are in a recession, even though I believe that we have been in one already. So it's clear to me that inflation is going to be going down pretty soon, while the unemployment rate is going to be going up. And this video is a fundamental viewpoint of the economy on where things are going based off data. So if you want more of that and you're not a subscriber to this channel yet, then make sure to hit that subscribe button and turn on that notification bell so you receive updates every time I post a video. And also make sure to leave a comment below. Let me know your thoughts on this video, particularly when you think the Fed is going to pivot, or do you think the Fed will just simply pause? And as always, thank you guys so much for watching. Until next time.